I think we're just going to wait for a handful of people to file in since it's the start of the event. Looks like the attendee list is starting to stabilize, but we'll just give it one more minute. Awesome. Well, I think we can kick off our event. So thank you everyone for joining us today. It's my pleasure to introduce Susan Wachter. She is the Sussman Professor of Real Estate and Finance at the Wharton School of the University of Pennsylvania and co-director of the Penn Institute for Urban Research. From 1998 to 2001, as Assistant Secretary for Policy Development and Research, Wachter served as the Senior Urban Policy Official and Principal Advisor to the Secretary of the Department of Housing and Urban Development. Wachter has also been a member of the Office of Financial Research Advisory Committee of the U.S. Treasury and is currently an advisory committee member of the Bureau of Economic Analysis of the Department of Commerce. Wachter is a 2022 recipient of the Quigley Medal for Advancing Real Estate and Urban Economics. A prolific author, Wachter is frequently cited in national media such as the New York Times, the Wall Street Journal, and Bloomberg Business Week. So without further ado, I would like to introduce Dr. Wachter.
Thank you so much, Coben.
So I think for context for those for our attendees, today we'll have a little bit more of an open forum, so feel free to ask questions throughout. I think just to kick it off, tell us about your research. Like what are the questions that you have tackled, and what are the things that you're accountable for when it comes to curriculum, to presenting, to research throughout Wharton?
Well, we have a real estate department because the school is so large. The school business is so large that there is enough room for specialties. So we have 12 departments. But when I first came to Wharton, there wasn't a real estate department. We were part of the finance department. I still am. But real estate's different than finance. It's similar in that it is estimating asset prices, and it's attempting to understand the trajectory of asset prices, and all of finance theory is applicable to asset pricing for real estate. But secondly, real estate is pricing assets over space. And so that really is bringing in urban economics. And to me, that's what's fascinating about the study of real estate, and it has its own discipline. So we basically actually started the department, and in the last years, decades, there's a whole the science of real estate economics has expanded tremendously with journals and with other real estate departments globally across the world, and some of which I've been involved in helping to set up as well. Real estate's 50% of the assets of the world, and for most households, it's their major asset. So understanding the long-run trajectory of real estate asset prices, home ownership, since that's the way most people hold real estate wealth, but also just investments in real estate is critical. It's critical for understanding access to wealth building and to diversifying for long-run wealth building. And also from a societal perspective, understanding booms and busts in real estate. And real estate, as it turns out, is very subject. It's more than any other asset class subject to booms and busts, and not only in the real estate sector, but bubbles and busts that bring down the entire economy. And that has been the base of my research. That's really what I've spent most of my time. And in 2004, 2005, as I left HUD and came back to Wharton, helping to set up the Department of Real Estate in the late 1990s, we had early warning of the bubble and bust to come. So I took it to heart to, since it wasn't understood, one of the basic assumptions historically, not so much anymore, is that asset pricing is efficient. Now, it is true, I am a finance professor also, and it is true that stocks do, in fact, follow a random walk, but real estate doesn't. And understanding the generation of bubbles was obvious. We were in a bubble, and that we were going to have a meltdown of the real estate sector. 2007, 2008, it was a bubble in the sense that a bust was inevitable. So my research is explaining why that's the case, what we must do to avoid that going forward. I have a book came out year before last on the Great American Housing Bubble, the 2004-2006 housing bubble, what were the causes, how to avoid it going forward. And I am currently working on the current instability in the housing market, which is not sourced from real estate, but it's certainly going to play out in real estate. And so I'm very much in the middle of thinking through implications of bubble formation right now, and what's the likely trajectory going forward for real estate pricing.
Got it.
Besides that, I also am interested in just more generally issues of affordability and access to housing as a kind of a second stream of research. And a third stream of research is not macro factors. Bubbles are caused by macro factors, but micro factors, how micro factors affect real estate pricing in urban areas and even in neighborhoods. So that's a long answer, hopefully not too boring.
Got it. No, absolutely not. And I think in context of today's real estate market, I think we have a lot of attendees who are curious, about what are the signs of bubbles today. But I think before we even talk about today, let's talk about 2007, 2008. What were the warning signs, that you're talking about that you saw, and have we addressed those sufficiently in your eyes?
Well, we have addressed them. Sufficiently, not so sure. In fact, I don't think so. But we have addressed them, and it's very important that we have, to the extent that we have, and I'll come back to absolutely critical that we have, to the extent we have. It's a bit of a temporary fix that we have, but it's been critical to where we are today. Because can you imagine if we were facing the macro issues that we are, and in addition to that, had a bubble which was due to lax lending, reckless lending, which is what the 2006 to the 2004 to 2006 bubble was attributable. So how did we know it was a bubble? We knew it was a bubble because all of the signals were saying that real estate lending was getting riskier. I'll go through a list of symptoms and signals of real estate lending getting riskier. But at the same time that real estate lending was getting riskier, the risk margin, the lending margin to real estate over treasuries, 10-year treasuries, was actually declining. That is, it was perceived by at least some lenders, the more naive, let's say, because some actually did understand what was going on, but it was perceived by many not knowledgeable lenders and investors that real estate risk was actually decreasing. And how were they explaining this, that real estate was decreasing in the 2004-2006 bubble when real estate prices nominally increased almost by 100%? How did they explain this? Well, it was explained by, obviously, real estate is doing well. Look, real estate prices are increasing. And it's not as strange as that may seem, but because if you are a lender or investor in real estate and you have a portfolio of real estate assets, as prices increase, your basis risk actually decreases. So it appears, so your portfolio gets less risky if you take the market prices as correct. But somewhere around, prices actually started going up in 2000. Right after the tech bust of 2000, prices started increasing in real estate. And that's where the 100% increase occurred. And that increase in price was, to begin with, perhaps attributable to low interest rates, the Greenspan put, which was an attempt to expand the economy coming out of the potential 2000 millennium switch. So there was some fundamentals, and income was increasing after the very mild 2000 recession. And as I said, interest rates were decreasing. But starting in 2004, treasuries started actually going up, which should be correlated with a decrease in asset prices. But instead, real estate and housing prices increased more than ever. They increased about 20% in 2005, and then again 2006, and all through up until July of 2006 when they started plateauing. So that year and a half real estate price rises was really not attributable to anything positive in terms of fundamentals, but what it was attributable is to about a tsunami of lending, $1 trillion of additional lending that came into real estate through subprime loans, through subprime lenders who either themselves regarded themselves as being inoculated from risk because they were offloading the risk, or they had credit default swaps, which they believed would be trustworthy and pay out. In the end, the government did pay out those credit default swaps. So in any case, if you saw this risk, and some did, the Big Short, they did, the way of responding to the risk would be to be on the right side of debt. That is to lend short. But in order to do that, a number of these players actually needed to have someone on the other side. So they both increased lending and borrowing. They were on the right side of it, but they marketed both sides. And that increased the indebtedness. There is no way, and there comes to the critical part, there's no way in real estate, unlike other asset classes, to consistently, in a large, effective manner, sell real estate short, which is why you get bubbles in real estate. Now, of course, you can sell REITs short, but they're a very small part of overall real estate markets. You can't sell your own home short. You can't sell single family short. So it's, again, you can sell builders, et cetera, but these are a small portion of the trillions, tens of trillions of dollars that are in real estate. And that's what the optimists get to they get their bid in. But it's not just that the optimists are getting their bid and the price is determined by optimists. as opposed to the other side weighing in. They can't weigh in, there's no short sales. But the optimists are using other people's money. And what's also true, because it's an asset class which doesn't transact frequently, doesn't mark to market through many sales, it's appraisal prices that determine what lenders will lend at, and appraisal prices are based on market prices. So we have a perfect storm for self-reinforcing bubbles. Optimists buy, and we've got market prices, which lenders use for justifying their loans, using other people's money. And then in the end, when it goes in the other direction, as prices start to fall, there will basically be margin calls, leverage will collapse, and the whole structure will collapse. And unfortunately, in 2007, it brought down not only the US economy, but global economies. This was astonishing that a subprime bubble in the US of perhaps several $1 trillion could bring down a global economy, but it can, and it did.
Got it. And so the mechanisms used to address that, right? I mean, we had a lot of regulation roll in after 2008, you know, whether it be like stress testing banks or going through and making sure that, you know, adding additional checks on lender quality or lending quality. I think, you know, I know that they were all implemented, right? But I think the question is that enough, right? And are the sins of the past, insufficiencies of the past, catching up with us today in any way, shape, or form?
I think they're not catching up. In fact, it goes the other direction, that the solidity of the banking sector, even as asset prices and have declined in other assets, obviously, and as we have a slowing of the economy, banks are doing exceedingly well, actually. And in part, and right now they're taking, they're building reserves for the potential recession to come. And that is because, as you say, stress tests and other aspects of Dodd-Frank, which required building balance sheet and fortress capital, et cetera. But it's not just that. That's half of the work, and it's critical, and it's important that that's in place. But also banks, even in 2006 through 2008, were securitizing much of this mortgage lending. That is, it wasn't on their books. And today, similarly, they're securitizing, but there's a big difference, which is the securitization is going through two entities, Fannie Mae and Freddie Mac, which today are basically owned by the federal government. But the critical thing is that the standards of the mortgage securitization are not eroding. And in fact, there are very strong parameters that are in place that Fannie Mae and Freddie Mac have put into place. And not that they too needed to be reformed, but they are in place right now to prevent undercutting of lending standards for the sake of growing the market, which is exactly what happened in 2004 to 2006, and basically could happen again, because how do lenders build market share? In good times, they build market share by increasing lending and possibly by taking additional risk. And that's okay, as long as the additional risk is their risk. But if the additional risk is building systemic risk, then it's something that needs to be overseen. And prior to 2004 to 2006, there was more of a sense that markets are self-correcting. We now know that real estate markets are not necessarily self-correcting. So we do need to have a buttress, we need to have guardrails in place to prevent this deterioration in lending standards, to get the loans out the door in good times, only to suffer potential systemic crises as the market unravels.
Got it, got it. And so some of those levers today, I mean, there's constant stories about very little down payments, right? Folks going, the average down payment amount decreasing in certain industries or certain markets. What are the levers that banks are pulling today in terms of like?
I could say just very extremely across the U.S., loan to value at the height was was almost 100%. There were basically no barriers to lending. So that kind of, and also we had teaser rate loans. So all of that is no longer for what was known as qualified mortgages, and Fannie Freddie can only issue qualified mortgages. They're only essentially, it's a little more complicated than that, but that's not what's going on. In fact, the lending standards are absolutely in place and are not being eroded over time. I should say that Fannie and Freddie are owned by the federal government, and that's not going to be a long-run solution. They will at some point be privatized, and how they get privatized and whether we go back to the kind of environment we had in 2004, 2006 is yet to be determined. So we still have that as a major issue out there because we're in a very temporary situation where these entities are quote unquote owned by the federal government, and this conservancy is understood to be temporary, although there's no action going on right now. But what is happening right now? What is happening right now is the housing price, because housing prices have increased dramatically, to a large extent because of fundamentals actually coming out of the work from home, seeking of space first to get away from the threats of contagion, but then to take advantage of working at home and no need to commute. That second office or finding a place for others to do, your child perhaps to come and during the pandemic at least do their schoolwork at home, do everything at home. But even so, going forward, work from home is a thing, and I believe it's going to be a long run thing. That's the surveys are indicating it is long run. So there is a demand for more activity to occur at home and therefore more space at home. And given that the demand has increased where supply doesn't increase proportionately, it's inelastic, as economists would say, housing prices based on fundamentals have increased. But housing prices have also increased due to low interest rates. That's a problem because interest rates were exceedingly low since the previous crisis. They declined dramatically, and they were 3% until March. They've doubled. They've more than doubled since March, not that many months ago. It's a testimony to the stability of the market and the controls that are in place that in itself has not caused a meltdown of the market. In fact, housing prices are amazingly resilient. Housing prices just now are, if you look at indexes as opposed to bids, what people are asking and the fact that they can't get what they're asking, but that's because they're increasing what they're asking over time. But housing prices now are flattening, and that's not a bubble. That's a soft landing. The problem is we're not at the end of this particular play. Maybe we are the end of the first act. We're into the second act, and how that second act plays out is going to be, unfortunately, I think, pretty bumpy because, as most economists, I too believe we will have a recession. And it's then that housing prices and start falling with declines in GNP. But the good news is that we're not likely to have the kind of implosion that we had in 2007 to 2010 with a recession actually due to housing prices. But we're not likely to have that because we're not likely to see a wave of foreclosures. So what happened in the previous crisis is as housing prices fell, people couldn't sell their homes, they couldn't pay back their mortgages. So we had 1 million plus more mortgages coming to the market, homes foreclosed, underwater homes coming to the market, feeding supply, and housing prices falling because of excess supply, causing more homes to be foreclosed upon, more homes being underwater. And that was a 2009 very, very scary moment. That was a moment of major systemic crisis where many different efforts, and finally a major effort of tax credits plus monetary expansion and QE got us out of it. So we're not there, and I don't see we're likely to be there, but we certainly are in for difficult times in housing markets, and we're already in a housing market recession from the perspective of the construction industry.
Got it. Got it. So I actually have a question from the audience, and this is about 2007, 2008. Were there any metropolitan areas that were more or less not as affected by the 2007 and 2008 crisis?
Yes.
And if so, is there anything that you think they did differently from the rest of the country?
Yes, and Texas, much of Texas, not Austin, but much of Texas wasn't part of extreme bubble and bust. Philadelphia, my metropolitan area, wasn't part of extreme bubble and bust. But the answer is there's nothing that was specifically done in these areas to maintain stability. Rather, this was an artifact of Texas at the time had a far more elastic supply. So that when housing prices never got way out of line with housing demand, in the sense that in Phoenix, Arizona, in Riverside, California, and many San Francisco, California, Los Angeles, many markets, particularly in the Southwest, when the demand, which was fueled by easy credit, reckless lending, when the demand expanded, it led to housing prices increases. As housing prices increased, expectations of housing prices increasing further became built in, what we call the cap rate. So the price to rent ratio expanded tremendously, but not in Texas. So in Texas, pricing stayed in line with rents, more or less, far more so than in California. But I have to say it's no longer the case. Supply elasticity has decreased dramatically in Texas, and price to rent ratios right now, many places in Texas where price to rent ratios are too high for current interest rates. So if interest rates persist and increase, then we will see, once recession hits, we will see prices fall throughout many markets in the United States. Not all, but many.
Got it. Got it. And so just to sort of push on that point a little bit, what's the role of zoning laws, if anything, in the housing
zoning
supply?
laws actually will, I mean, they're exactly to the point. Regulations and zoning laws make supply less elastic and more, and then the metro areas or regions that are subject to regulatory controls will more likely find themselves in bubbles than other places.
Got it. Got it. And then I think to sort of go back to the tune of today, as we talk about, the impact of inflation and specifically shelter on inflation, is there anything, that is driving that, driving the increase in housing prices? I know we talked about earlier, like lower interest rates, elastic supply. Are there other factors that we should be keeping our eyes out on, or anything?
Sure.
Yeah.
So yes, lower interest rates, of course, were key to this this incredible run-up. As we just said, technology, a key to the run-up, and the run-up is not uniform geographically, but in farther out suburbs and in aspirational quality of life markets, Boise, Idaho, St. Croix, Idaho, these places that are places where they're beautiful. You can have second homes, and you can work from home in the second home areas. Miami, these are the places. So technology is absolutely critical in today's house price run up, and interest rates absolutely critical. But of course, interest rates are now, as we were just saying, double what they were just a few months, 6 months ago. So what's happening right now? So what's happening right now is actually not only are housing prices elevated, but rents are elevated. And that's kind of a surprising outcome, because it's not interest rates that are causing rents, except indirectly. It's very difficult for potential first-time homeowners to get into the ownership market. They're increasingly living with their parents. That's hitting all-time highs. And they are increasingly renting. So the fact that it's hard for millennials, and we've got right now, a large cohort of population is in that millennial buying, and they can't buy, and they're pushing up demand in the rental sector. So rents are rising. Now, rents and owner's equivalent rent is, in fact, depending on how you're measuring it, between 30 and 40% of the CPI. So this housing bubble, which in part happened because of, as we said, technology, interest rates, and also because of policies that help put money in people's pocket to deal with the pandemic and its aftermath. People actually have saved a tremendous amount of money, enough for down payments for many people. But those who don't have sufficient savings are faced with huge down payment requirements, and now the interest rates are high, debt to income ratios that are unaffordable, and that is pushing them into the rental market. So this interesting phenomenon we have going, and I just recently read about that, and I'm not sure if the audience has seen what I've written on this, but there's an interesting paradox here. As the Fed has raised rates, current owners are in some cases less likely to sell, because if they sell, they're going to have to get a new mortgage. So older homeowners, perhaps, who are looking for retirement, that's different. They've paid off their mortgage, they'll sell. But many people who are perhaps would go for a trade-up home, but their mortgage rates are 3%. They're not interested in selling just to go out and have to borrow at a double the cost. So this is actually decreasing the supply of homes on the market. And that is ultimately what determines the future direction of prices, is the inventory. It's a supply and demand, Econ 101. And the inventory has been at historic lows. And although it's increased somewhat, it's still at historic lows. And in fact, in recent weeks, the inventories have decreased. I'm not talking for new homes. I'm talking about the far larger existing home market. So as long as we have an inventory shortage, we will not see a housing price implosion. But as mortgage rates go up, and the Fed is stalwart, they are not giving up on pushing rates higher. As interest rates go up, there will be an increasing share of borrowers that are unable to borrow, that are precluded from qualifying based on down payment, or more likely, as interest rates go up, debt to income ratio. The two go together. And so as they are increasingly a larger share of the market simply cannot afford housing, that we'll see eventually that prices will respond to a declining demand. And it's just a question of how high mortgage rates have to go to bring about that decline in demand. Once the decline in demand is sufficiently large, inventories will start growing. And once inventories start growing, then in fact, there will be a reinforcing sales on the market, because another reason why inventory is so low is just the fact that you can't find another house to buy. So once that eases up, I think there will be we'll see it's not a non-linear decline in net demand, an increase in supply as demand decreases because of Fed action. But it is a concern how high mortgage rates are going to have to go, because there's a delay, there's a gap, 6 months to a year between housing prices beginning to fall because of these actions of the Fed, and the CPI registering a decline in owner's equivalent rent. So there is a real concern about how deep a recession the Fed pushes for in order to get to stable prices, particularly because the CPI is based on a delayed measurement. Now, even so, the Fed's preferred index is not the CPI, but the PCE, But the PCE also has a very large segment which is dependent on rents. So there also rents are averaged over a year. And so really what one wants to look at is new leases. And if you look at new leases right now, rents are stabilizing. So I'm hoping that I'm sure that the Fed has folks that are watching these trends very carefully.
Got it. And we have another question from the audience. So this is a little more anecdotal, but I've seen some builders beginning to discount new homes here in Texas and in Oklahoma. Is that a factor of their costs coming down, or are they trying to cut the market off and pass and offload houses they've already started so that they are sold before the market really starts to tank?
Both.
Both.
And also, they don't want to hold on to those houses even in good times, because they pay the capital cost of those houses, so they always want, of course, to sell it. But there is a cut in margins that's occurring on right now. Builders are offering deals; they're cutting their margins in anticipation, not only because they want to get product out the door, but in anticipation of the market getting more difficult. But it is also true that costs are coming down. So as building activity has decreased somewhat, lumber costs have come down dramatically. So all of the above. I expect, however, that inventory for new homes has increased dramatically. So, and by the way, this is not uniform across the country. You can see in different parts of the market where this price cutting is going on, where the excess inventory is more pervasive, and it absolutely is in the Southwest.
Got it. So I have another question. Do you believe that there are limits to the continued growth of new home construction? And if so, do you see that as one of the greatest barriers? What do you see as the greatest barrier to continued new home construction?
Not sure I understand the question.
Sorry, effectively, do you believe that there are limits to continued growth of new home construction? And
well, right now, I think construction activity is decreasing, but that's a temporary response to the fact that housing prices for new construction are coming down and inventories are high because, again, new home construction tends to be on the pricier side, and it's being hit by mortgage interest increases more than other markets, than existing home markets. So yeah, so right now we're on the downside of construction activity for sure. For 2023 is going to be lower construction than 2022. However, I'm not sure whether the questioner is asking this. Going forward, we need more construction in the U.S. There's just no doubt about it. We have a deficit of supply of housing, not a surplus.
Yeah, and I think one of the things that the questioner really wants to understand is like, what are the greatest barriers to building that surplus?
Yeah. To building sufficient in response to demand, to building sufficient supply in response to demand, which, population is slowing, but we still have population growth. So we still have significant demand, and we have a backlog of demand. We've had household formation, which is greater than new starts for a number of years. This is because basically construction costs have increased. So builders have to build that into their prices, and prices are just not affordable in new construction for many. And overall, we're, depending on estimates, we're 1 million to several million short of new homes. What's it due to? It's due to costs of labor. It's due to costs of materials, but mostly it's due to the availability of land for development.
Got it. So then I guess question on a similar strain. In terms of the already existing supply of housing, there have been constant topics and conversations about the role of private companies coming in and buying up inventory. We'll hear things like KKR, is entering this market. What's that doing to housing supply? And is that one of the top line issues, or is that just something that is sort of strummed up by the media?
No, it is an issue. It's a top line issue. However, note that there is two sides to the issue. When housing is built to rent, new homes constructed, not for ownership, but for renting, or when homes that are owner occupied are purchased and then put back out as rental markets. And both models are increasing dramatically, so that in many markets, 20% of the market is build to rent or own to rent transition. They're increasing the supply of rental units, and rents have gone up relative to wages dramatically as well. And arguably, the rental market is the market where we should be even more concerned about costs, because rental markets, lower income households have no choice but to rent. So it's a fraught issue, there's no doubt about it, and particularly concerning that young households have the ability to get on that ladder of homeownership to protect themselves against rent increases. And that's not happening right now. Today, we're seeing young households being hit by the inability to become homeowners and also suffering rent increases. So making it difficult to save for homeownership, which is why we have all-time highs of young households, young adults living in the basements of mom and pop.
Got it. Yeah. And I think we have another follow-up question from the audience. So at the crux of the pandemic, real estate became the commodity of choice for a wealth transfer as a defensive asset. Then, as the government stepped in to support renters, the prices were propped up. Now, the common consensus is that build to rent is the key to a thriving market. How would you argue that this is not just a stepstone to government gaining control in times of tremor? You mentioned that privates must take back government-sponsored enterprises. What business is capable of doing that?
Good questions, very good questions. What business is capable or even interested in a privatized Fannie Freddie? Absolutely. Yet, interestingly, at the end of the last administration, there was a push to privatize. They couldn't get it done, couldn't get it at the time, and there supposedly were entities which were interested in being part of the market. I think a key to that, however, would be an explicit government guarantee for those mortgages, to protect lenders, investors for those mortgages against default. And that would be an additional step, which is not right now in the market. Right now, in theory, Fannie and Freddie are entities which are owned by shareholders. Just so happens that the shareholders are the U.S. government. But there are court cases right now in place that at some point these entities need to go back and be privatized. At that point, the question is privatized how? With or without a federal government guarantee, and there are people who argue both sides of that.
Got it. So I think another question that's sort of coming to play is what is the role of inequities in terms of race, gender in the current housing market? You know, we have a history of redlining in Dallas. I think it's extremely apparent if you go to South Dallas, it was redlined before. A lack of opportunity to sort of go north for a lot of folks. What are the impacts of those things today? And you know, what are we seeing in the market?
It's a major problem because of many people get on the ladder of home ownership through intergenerational wealth transfers. Minority home ownership is in the high 40%. But it was in decades previously as high as 50%, went from 45 to 50%. Now it's back down again. Households, home ownership rates except for the young millennials and minorities, isn't so bad actually. But it is important, especially in times when rents are increasing and housing prices are increasing, and to the extent that we have pervasive supply controls and zoning regulations on a local level, which are restraining supply, we can expect that housing prices and rents will continue to rise. So the only way to protect against this is to hedge, in a sense, and get into home ownership. So then as a homeowner, you're on both sides of it. Your house price will increase. And if you've got a long-term fixed rate mortgage, then your payments don't increase over time. You can build wealth. So I think we should be concerned about the ability of people to get on that housing ladder. We in the US have since 1960 or so, right after World War II, we had introduction of major innovations and very good, strong policies, which have stand the test of time. As I said, there was a major shift in policy, which we could, if anyone's interested, that led to the meltdown of the subprime crisis. But prior to that, home ownership was 2/3 of the US households were homeowners. But we are now in a potential situation where home ownership will not be accessible, and we may see a decline in, we may go down to under 60%. We might be in the 50% range as the population ages. So this is a major concern. It's a major concern for building wealth and for neighborhoods where home ownership is often the basis for building family-friendly self neighborhoods. I'm concerned and hoping that housing, most importantly, that we get interest rates back down to levels that we have seen. There's no reason why we can't get back down to long-term interest rates that are affordable. It depends on inflation expectations, but if we can contain them, and we should be able to, we did for decades, we can return to the halcyon days of few percentage of interest rates, and also we need to attend to the supply side. And that, of course, is perhaps the subject of an entirely other webinar, but there's work being done on that, and we're in the middle of that. We're looking at a measure of where is the supply side actually welcoming, and there are communities across America where actually you can build, and you are building. And perhaps that's where we need to see more infrastructure, and we need to see a whole panoply of family-friendly delivering communities where safe, good education, and affordable housing. Not impossible.
So I think we have about time for 2 more questions. We have one from the audience right here. It's a relatively short one. But do you have any insights into the Evergrande and China collapse? And are there any similarities here in the US?
Perfect. Great question. It is another example of a real estate boom and a banking bust. In this case, the banks, quote unquote, are these investment funds, which are often actually owned by municipalities. It's a classic bubble. So we had the subprime bubble. Prior to that, there was an Asian financial crisis, which was real estate based in 1997. And prior to that, there was a Japanese bubble of 1990 and lost decades, and housing prices still haven't returned to their bubble heights in many, many decades of slow growth. And I'm very concerned about China and as your listeners may well be aware, China for first time, I don't know how long, is not reporting its current economic performance. And why is that? We don't know, but there are real concerns about Evergrande, of course, these companies, but it's not just these companies that were way, way, way too leveraged, but it's also the municipalities who are leveraged, and that's a major concern.
Is there any global systemic risk associated with some of that over-leveraging?
There very well may be. And fortunately, when in our subprime bubble, our subprime securities were owned across the world, not so much in Asia, but absolutely in Europe. So banks like Deutsche Bank and Credit Suisse, whatever, were extremely exposed to our subprime, which meant that these entities also went under, and Europe was absolutely exposed. So this was a global crisis. I think that the property sector of China, there are investors outside of China are not. There are of course investment funds that are exposed, and they've already taken a major hit. But U.S. banks, European banks are not exposed, which is an extremely good thing. In part, I think the bubble in China, people have been aware that it's been building. People have been warning about it, and it's the very same phenomenon of housing prices being built up with expectations of future growth, that growth will never end, fear of missing out, get in and borrow as much as you can, and over leverage, and banks, lenders praising out at current market prices, which are not based in fundamentals, particularly because the demographics have shifted in China. Growth is no longer to be expected. Population growth is slowing. It might actually have already gone to 0 point. So this is a major concern for China, but I don't think it's a global systemic issue. But of course, it will lead to slower growth, global growth. It will be one of the factors that may lead us into a global recession for 2023, which unfortunately is a potential outcome.
Got it. So we have one final question, and this is a pretty fun one. Ray Dalio suggests programs to invest today into future consumptions, such as homes or education. This has been quite the root of the Chinese housing crisis. Do you think this suggested investment vehicle for people who cannot afford a home is now viable?
I'm not sure which is the investment vehicle. Help me with this, Kovan.
I think the investment vehicle is the program itself to invest today into the future consumption of a home. Like the buy now.
In short, no. So stay tuned. I, with a group, are trying to stand up a exchange where you can buy and sell interest in neighborhoods. So we can get that sell side. So I think if there's a buy side, there ought to be a sell side. Without that, there was a tendency to bubbles, and I'd be wary about that.
Got it. Yeah, we'll absolutely keep our eyes out. Well, we have no further questions. I appreciate your time. I think this was an extremely delightful session. We oftentimes sort of lack perspectives on housing and certain macroeconomic environments within the Tire Center. And so we really appreciate you coming in today and just sharing your thoughts with us.
Well, thank you. I appreciate being here. Great questions. If any of your listeners want to contact me, feel free to do so. It's Wachter@Wharton, pretty simple. Wachter@wharton.upenn.edu. Love to hear from you.
Awesome. Well, thank you, everyone. Thank you, Wachter. I really appreciate everyone attending, and hope everyone has a great night.
Thank you.
Bye, everyone.